Hello, and thank you for tuning in to Asset Culture. My name is Letitia, and my goal here with this channel really is to cultivate an environment where you can learn how to acquire, grow, and protect your assets. So, there's a lot of different types of assets. You, for example, are an asset. Your different accounts, your checking, your savings, your retirement account is an asset, investment accounts are assets, property, so your home that you own is an asset. Also, we have intangible types of assets as well. So, your skill set is an asset. So, think about what it is you do and how you make money. It pays you, right? So, it's adding some kind of economic value to you as an individual. So, as you can hear, right, there's a lot of different types of assets, and the way that we're going to develop this knowledge and understanding of how to acquire, grow, and protect our assets is through financial education. Now, today is April 1st, the first day of Financial Literacy Month, and what we are going to focus on is protection. And how do we protect our assets? One of the ways that we can do that is via life insurance. But let's get into life insurance. We're going to talk about the different types of life insurance, their different uses, and we're also going to figure out how you can determine what's the appropriate amount of life insurance for you and your specific situation. But let's get into it. All right, so we're going to discuss what life insurance is, the different types, uses, and benefits of life insurance, and I'm going to give you a way to calculate how much life insurance it is that you need depending on your unique situation. Now, what is life insurance? In simplest terms, life insurance is a contract with an insurance company. You're going to agree, hey, I'll send you a monthly, quarterly, maybe even yearly payment. In exchange, that insurance company is going to promise you a death benefit. You pass away, someone in the family is going to get a lump sum of money tax free. As you can see, there are several different types of life insurance, but generally we have temporary life insurance and we have permanent life insurance. So we'll start with temporary, which is going to be term life insurance. Now, that's coverage that you have for a specified period of time. Usually it's 10, 20, maybe even 30 years. What's going to happen with that? Simplest terms, you pay your premium every month, keep your policy current and active, and if you pass away within that specified term, period of time, the insurance company is going to pay out whatever agreed upon death benefit to your family tax free. That's temporary. Okay, let's talk about the different permanent options. First one is going to be whole life insurance. Just like term life insurance with whole, you're going to have one set premium payment. You pay that amount for the life of your policy typically, but you can have a set payment period. That could be 20, 30 years. Maybe you pay it until you're 65 or 90 or 100 years old. But you have that coverage. Anything happens to you, you pass away, that is permanent. So as long as you're paying your monthly premiums, you don't have to worry about that policy lapsing or expiring on you. Next, we have the three different types of universal life insurance. Your general universal life insurance, just like the other two types of universal life insurance, they're all going to have flexible premium options. So the way that you pay for that policy can be flexible, meaning there is not one set amount that you're going to be able to pay. There's going to be a minimum that you need to pay every month to cover the cost of that life insurance, but you can put more into these policies because they have cash value and they are going to grow for you. Now, with each of these different plans, you're going to have a specified period of time that you're making those payments for, and that can vary widely, but that's going to be discussed between you and the company, and you're going to decide that period you're going to pay for it and whatever budget you're comfortable with. Now, as far as the cash value component of universal life, with your traditional universal life, you may get around 2 to 5% interest on your cash that's growing in there. Index universal life, that interest rate is going to fall between 8 to 12% typically, but it can be more. It really just depends on the market, how the market is performing, what interest rates are currently, and things like that. Now, variable universal life insurance is gonna function more like life insurance connected to the stock market. And what I mean when I say that is, we know that the stock market is a variable form of investment, meaning you can make a lot of money, but you can also lose a lot of money. So, with this type of life insurance, there is much more risk associated with it because you can lose money based off of stock market performance as compared to the indexed universal life where you cannot lose money based off of stock market performance. Now, death benefit with all of these policies can be one fixed amount. So let's say you wanted a $400,000 death benefit. You decided that from day one, all of these accounts can function in a way where that amount stays the same. Now, with your term life insurance and your whole life insurance, it is going to be fixed. But the universal life insurance, because of that special cash value component where it is going to grow for you and you can access those funds in later years of that policy, your death benefit can also increase over time as your cash value increases. So that is a great component of that. Say right now you may only need $400,000 in death benefit. Maybe by the time you're expected to pass away, maybe 20, 30 years, you expect to have $200,000-$300,000 more in life insurance. So that is something to consider with these different policies. But let's talk about the specific uses and benefits of life insurance can vary a lot from one policy to another. But generally speaking, with term and whole life insurance, those both you're focused mainly on, well, only on having that death benefit, which is going to be tax free. So someone passes away, someone gets a lump sum of money. Now, the other kinds of life insurance, universal, indexed, variable, universal life, those three kinds of policies can have several different benefits like cash value withdrawals, compounded interest, no mandatory distributions on your cash value like you would have with a retirement account. You could also use these plans for education purposes for a child that you have now, and you want to plan for them to be able to go to college and not have to worry about paying for it. You can also build a retirement savings, something maybe more so supplemental if you have like a 401k already in place. Also, these funds within these life insurance policies, they avoid probate. So you don't have to worry about going and sitting through court and waiting for the state to decide what's going to happen with death benefit proceeds. Also, universal life, index universal life, variable universal life, even term life, you can have long-term care like features added on to them, or say you get diagnosed with a critical, chronic, or terminal illness. These policies can be set up to where there's a feature on them where you can access that death benefit while you're alive and help take care of those medical expenses that you have while you're, going through whatever medical situation you may have. So that's a feature that a lot of people don't realize you have with life insurance. Also, life insurance is protected from things like lawsuits, creditors, judgments, tax liens, even bankruptcies. Now, some states do have special rules where you're going to have to apply the laws that are associated with your state. So, that is something that I won't go into detail with because it can change from one state to another. But as you can hear, there are several different benefits for someone when they have life insurance. and it goes way beyond just having that death benefit in place. But let's just talk a little bit about some different things that we look at when we are designing a life insurance policy for someone. Okay, so let's look at how much life insurance someone could need based on their circumstances in life. So this is a calculator that we can use. One method of determining the amount of life insurance someone needs is called the dime method. So we take your total debt, your income times 10 years, mortgage balance left or rent times 10, and education expenses if you have kids and you want to put them through college. So let's just say we have someone with debt. Maybe they have credit card debt, a car loan, and student loans totaling 50,000. Next, we move over to income. Let's say they make $50,000 a year. We multiply that by 10. We're looking at 500K, $500,000. So far, we're at $550,000 in coverage. Next, let's add on the mortgage. Let's say someone has a balance of $300,000 left on their mortgage. We're going to add that to the debt and income, and we're looking at about $850,000. Lastly, education expenses. Maybe they want to put their kid through college. Let's just round it out and say they want to leave behind 150K for this child to go to school, and that should give them a great list of options for where they want to go to school with $150,000. If they need more, maybe they have grants, scholarships, and things like that to rely on. But let's call it 150K. So $50,000 in debt plus $500,000 in 10 years of income plus a $300,000 mortgage and education expenses of 150K, we are looking at $1,000,000. So based on this method, this individual would need $1,000,000 life insurance policy. So that is one way of determining what death benefit someone should be looking for in order to offer an optimum amount of protection to hit some of those things or targets that and goals that they had in place if they were to, pass away or when they pass away. So we don't want to avoid these conversations. It's important that we do, tend to these things and discuss them and prioritize, having a plan in place while we're alive and while we have the capacity to do so. So that is it on life insurance. It has been a pleasure to explain some of these things and kind of break them down to you. It gets way deeper than this. There's a lot more to talk about with life insurance, but I just wanted to provide a surface level understanding about how life insurance works and some of the key benefits associated with it. So if you found any value in this information, like, share, comment on this video, even consider subscribing, and I look forward to sharing more with you guys.